Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 27th of August 2020. And Jerome Powell has announced today that the Fed is prepared for inflation to overshoot its 2% target if necessary in order to maintain stimulus measures to aid its faltering economy. In fact, what is being suggested is that rates could indeed remain at current levels, virtually 0%, for potentially as long as 5 years. And some are even commenting, perhaps, that they will never be raised. Though we disagree with that, as we foresee a reset coming, possibly towards the end of this decade. So let's take a look at what Bloomberg reported just about an hour ago. Bloomberg article dated August 27th, 2020 at 7:29 p.m. GMT+1. which at the time of producing this is a little over an hour ago. Headline: Powell's Fed shift allows for higher employment and inflation. Federal Reserve Chair Jerome Powell unveiled a new approach to setting US monetary policy, letting inflation and employment run higher, in a shift that will likely keep interest rates low for years to come. Following a more than year-long review, Powell said the Fed will seek inflation that averages 2% over time, a step that implies allowing for price pressures to overshoot after periods of weakness. It also adjusted its view of full employment to permit labour market gains to reach more workers. Maximum employment is a broad-based and inclusive goal, Powell said Thursday in a speech delivered virtually for the central bank's annual policy symposium, traditionally held in Jackson Hole, Wyoming. This change reflects our appreciation for the benefits of a strong labour market, particularly for many in low and moderate income communities. During the longest US economic expansion on record, until the pandemic hit earlier this year, many groups benefited, including minorities and women. With millions out of work and unrest flaring up across the United States over racial inequality, questions about how the Fed's policy helps diverse communities have been raised. While the new strategy doesn't target a specific rate of unemployment broadly or for certain demographic groups, it does give the central bank flexibility to let the job market run hotter and inflation float higher before taking action. They really are not going to be raising interest rates anytime soon, said James Knightley, chief international economist at ING Financial Markets. The Fed is saying rates will be lower for longer. But don't worry, inflation is not going to be picking up. Achieving an overshoot of inflation in the near term will be difficult. Unemployment is above 10%, and the economy is still recovering from the shock of virus shutdowns that inflicted the steepest recession on record. Powell's speech left the matter of how tactically they would aim for higher inflation for future Federal Open Market Committee meetings. With a new strategy in place, Goldman Sachs chief economist Jan Hatzius said he now expects changes to the forward guidance and asset purchase program to come at the September policy meeting. St. Louis Fed chief James Bullard later said in an interview on Bloomberg television with Michael McKee that we're going to try to make up for past misses. But judgments about how to do so were for policymakers, and there are different opinions around the table. If you wanted to stay on the price level path that was established from 1995 to 2012, you could run 2.5% inflation for quite a while, he said. In the new statement on longer run goals, the Fed said its decisions would be informed by its assessment of shortfalls of employment from its maximum level. The previous version had referred to deviations from its maximum level. The change de-emphasizes previous concerns that low unemployment can cause excess inflation. While expected, the announcement of the strategy shift came sooner than some thought. After first fluctuating on the news, US stocks resumed their record-breaking rally, and the Treasury yield curve steepened to the widest in 2 months, as traders bet policy rates will remain locked near zero for even longer. Calling the revised strategy a robust updating, Powell said that after periods when inflation has been running below 2%, monetary policy will likely aim to achieve inflation moderately, note that word, above 2% for some time. The shift, he announced, is a product of an unprecedented review of Fed strategies, tools, and approach to communications that began in early 2019. Fed officials said they will now conduct such reviews about every 5 years. Since the central bank officially set its inflation target at 2% in 2012, the Fed's preferred measure of price increases has consistently fallen short of that objective, averaging just 1.4%. That challenge was part of the impetus for the strategy review. Low inflation contributes to low interest rates, which reduces the Fed's ability to fight off economic downturns, potentially making them deeper and longer. Indeed, the strategy document pointed out that this limitation on their policy rate means downward risks to employment and inflation have increased. Powell is not only saying that they will be more patient in removing the punch bowl in the future, he has changed the recipe for the punch, said Mark Fittner, senior economist at Wells Fargo & Co. While the timing comes slightly earlier than had been expected, the Fed is far better served to underpromise and overdeliver, or deliver earlier in this case. Even so, the document leaves the Fed ample room to fight a run-up in inflation. Powell noted the risk, saying that if excessive inflationary pressures were to build, or inflation expectations were to ratchet above levels consistent with our goal, the central bank would not hesitate to act. Fed officials also altered the strategy document to include a section acknowledging that financial stability can also affect their ability to reach their longer-term goals. Sustainability, achieving maximum employment and price stability, depends on a stable financial system, it said. Therefore, the committee's policies decisions reflects its longer-run goals, its medium-term outlook, and its assessments of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. Powell has emerged an unexpected change agent in the role of chairman. Whilst he isn't a PhD economist, his first speech at Jackson Hole in 2018 discussed the risks and uncertainties around the basic parameters of policy making. As President Donald Trump's pick to helm the central bank, he engaged the Fed in a dialogue with moderate and low-income communities across the United States and steered the economy toward lower rates of unemployment that benefited Black and Hispanic communities. He aggressively expanded the Fed's emergency lending authority as the coronavirus took hold in March, slashing rates to zero, and extending aid to municipalities, small and medium-sized companies, as well as large corporations. Now, before we leave here, we look very briefly at an article dated yesterday, and I'm not going to read all of this, but yesterday it was predicted that the Fed seen holding rates at zero for 5 years in their new policy, and it basically said the Federal Reserve looks likely to keep short-term interest rates near zero for 5 years, or possibly more, after it adopts a new strategy for carrying out monetary policy. Okay, US equity markets are not closed yet, but are broadly in positive territory at or around 0.5% to 1% higher today. while European markets are down by a similar amount. The dollar index is down, just dipping below 93 at 92.98. And although gold prices peaked earlier today at $1,976, they're now languishing at $1,931, which is around $10 lower than their close from last Friday. Silver prices also peaked earlier today, reaching $27.95, but they too have fallen back and currently stand at $27.02, though they have been much lower at $26.63. So what are we to make of what Jerome Powell has said? Well, the indication is that we're going to have a low interest rate environment for some considerable time. For some reason, Japan springs to mind. Possibly up to 5 years, and who knows, even longer. Now, we have stated for well over 12 months that MMT, modern monetary theory, is becoming the gradually more favoured economic model. And whilst we're not there yet, it's being adopted by stealth, or certainly that's our argument. To think it was a policy much maligned by the right in US politics as being the failing economic policy of the left. And yet, under a Republican administration, we are actually witnessing it being brought in, with some vigour, but under a different name. Now, with this news, we would have expected to see precious metal prices actually rise, especially as the opportunity cost of holding them is now tiny compared to interest-bearing investments. That said, equity markets will also like this news, at least short term, as it continues to suggest a favourable economic environment against which companies can now borrow. When I say economic environment, I mean a financial environment, because with low interest rates, they can arguably borrow more money. We suspect markets will take a little time to digest this news and work out its implications. But for us, it confirms that regardless of whatever direction precious metal prices move in the short term, between now and 2025, we can expect to see higher gold and silver prices until at least rates then begin to rise again, which will now almost certainly be quite a few years before we witness such an event. The tailwind behind precious metals is now firmly established, and as we have said for some considerable time, buy on dips, holding for the medium to long term, and you will not go far wrong. What do you think? How do you think markets have responded to this news? Why haven't we seen a greater improvement in precious metals, as it now appears that low interest rate environment is here to stay, almost regardless of what happens to inflation, or at least within certain limits? Thank you so much for listening. If you haven't already done so, please subscribe to the channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.